For this session, we're going to focus on instant payments, the legal and compliance landscape. I'm Jess Chang, a partner at Wilson Sonsini, and my practice is dedicated to the payment space. I've worked in payments for over 15 years, and before joining Wilson, I was senior counsel at the Federal Reserve Board. And among other things there, I got to write the federal regulations, the rules underpinning the FedNow service. So what I'll do today is share some key takeaways on instant payments. So in this session, I'll talk about what instant payments are and how they fit in the broader US payment system. Then we'll dig a bit deeper on some key legal and compliance issues. And I'll end the discussion with some insights on the interplay with other laws like the Expedited Funds Availability Act and its implementing regulation, Reg CC, sanctions, and also recent supervisory scrutiny around bank fintech partnerships. So just to level set a bit here, an electronic payment generally has three parts, three components. First, the payor initiates the payment through an end user service. So you can think of an online payment interface or mobile app instructing their bank to make a payment to the recipient. So the payor and the recipient interact with end user services. That's the first part. Really briefly, the second part, the payor's bank, it sends a payment message containing the payment details to the recipient's bank through a payment system. So this ability to send information, to send a payment message, it's provided by a clearing service. So that's the second part, clearing. That's the exchange of information about a payment. And finally, when a payment is completed, that happens when two banks transfer funds through a settlement system. So settlement usually involves a debit and a credit to the accounts to move funds from the payor's bank to the recipient's bank. And that's the foundation for most payment systems. It's these three parts, the end user interface, clearing and settlement. And it could be divided across different systems, and different providers compete with each other to provide each part. So for instant payments, there are two systems today that compete to provide the clearing and the settlement parts. That's the FedNow service. It's offered by the Federal Reserve banks. And there's a private sector instant payment service. That's the clearinghouse's RTP network. Now, what is an instant payment exactly? Just briefly, instant payments, they allow consumers and businesses to send and receive funds from their accounts at banks and credit unions, and they do so in real time, at any time of the day, any day of the year, with immediate funds availability to the receiver. So the benefit is to the recipient, where you can have immediate access to funds. Think of, for example, gig economy workers who can have instant access to their wages within seconds. They'd be able to spend it right away rather than waiting for it to process over traditional systems. There's also benefit for payors, where just-in-time payments that can help manage cash flows and bank accounts. So think of, for example, consumers who can now pay a bill last minute at the very end of the day on the due date and avoid late fees. Instant payments, they can also help the federal government in dispersing support payments faster during emergencies. Now, what is unique about instant payments is that the clearing and settlement of funds occur almost instantaneously via services that operate 24 hours a day, 7 days a week, 365 days a year, all the time. And this is new. While we see banks and fintech companies introduce various faster payment products and services, actually many of these solutions, despite their appearance, they actually don't involve the movement of funds in real time, but rather clear and settle funds through traditional payment systems where it can take days to process. And you can see in this diagram that an instant payment system, it actually isn't offered directly to individuals and businesses. Instead, it allows customers of banks, and these banks offer the service for their customers to send payments, again, at any time, where the recipient can receive full access to those funds immediately with instant finality of payment. So at its most basic level, instant payment systems, they provide interbank clearing and settlement that enables funds to be transferred from a payor's bank account to a receiver's bank account immediately at any time. So let's walk through a hypothetical of how this works, the process involved. So let's say Kermit the Frog wants to make an instant payment to Fozzie Bear, and that means money gets pushed forward from Kermit's bank account to Fozzie's bank account. So you see in the diagram, there are banks involved. There's Kermit's bank where he has a bank account and Fozzie's bank where Fozzie has a bank account. And again, what is new with instant payments is that the clearing and settlement between banks, it happens really fast and irrevocably. So step one in the whole process, Kermit uses an end user interface to initiate an instant payment with his bank. His bank validates the payment according to its own internal processes and requirements. Next, Kermit's bank submits the payment message to the instant payment system. So that would be either RTP or FedNow. Then that system validates the payment message. It checks to see that the payment message meets the proper format specifications and complies with any controls that apply. If so, then the payment system sends that payment information on to the receiver's financial institution. So that's Fozzie's bank. The payment system asks that bank to confirm that it intends to accept the payment message. So the bank can indicate one of three things. It can indicate that it intends to accept, or that it will reject, or it accepts without posting, which means some of the pre-checks of the payment message are still pending or delayed, and we'll come back to this in a bit. So it's in this step that the bank, so Fozzie's bank, will want to verify that it actually does maintain an account for the recipient identified in the payment message. So the bank will want to check that Fozzie is actually an account holder. Next, if the bank indicates that it intends to accept the payment message, so we're on the happy path here, the bank sends a notification to the instant payment system confirming that it intends to do so. And what is key here is that so far, all of these steps we've covered, it's just been an exchange of information. No funds have actually moved. The payment message itself hasn't been sent or accepted by Fozzie's bank yet. And this is why an instant payment is so fast. All this back and forth pinging, these verifications and checks are done first. And then once the recipient's bank gives a green light, again, we're on the happy path where Fozzie's bank says that it intends to accept, the payment system itself just settles the payment. So for FedNow, this involves a debiting and crediting to the designated master accounts of the sender bank and the receiver bank. So that's Kermit's bank and Fozzie's bank, respectively. And all of this is completed within a few seconds. So note also that there's an important last step in the payment flow. So that link between Fozzie's bank and Fozzie. There's a requirement in the service terms for FedNow and RTP that Fozzie's bank must post funds to him immediately after interbank settlement happens over the system. So Fozzie, go ahead, Ashley.
I was going to say, we have a question here that just says, can you talk very briefly about the difference between an instant payment and a wire transfer so they can get a better understanding of what they're dealing with here?
Yep, absolutely. I'll get to this in a little bit, but fundamentally, an instant payment is a wire transfer. It's governed by UCC4A. It involves a credit push payment. But there are actually key differences here, and that's what enables an instant payment to have end-to-end completion within a few seconds versus a wire transfer, which is an open system where a payment message can wind its way down a long, possibly endless, there's no limitation there, chain of banks, intermediary banks, before it makes its way to the receiver. So at its crux, that is the key difference. And I'll go into that in a little bit, but that's a great question because from a legal standpoint, so this is looking at UCC Article 4A, Reg E, the interplay. There's very little different between an instant payment system and a wire transfer system, except for the distinction I mentioned now, and also that an instant payment system is designed for a retail use case where there are consumers involved. We'll get into that too in a bit.
Thank you so much.
Yep. So I think I was up to that last step there. So the last step between Fozzie's bank and Fozzie, this is really key because there's a requirement in the service terms for FedNow and RTP that Fozzie's bank has to post funds to him immediately after interbank settlement happens over the system. So what this means then is Fozzie has immediate access to final funds through his bank. That last step is outside of the instant payment system, but the immediate posting requirement is a service term, a requirement of the instant payment system. And this matters a lot to Fozzie. It is also important in American households and businesses. Fozzie doesn't have to wait days for funds to be available, and he can use those funds with confidence that it won't be revoked or undone. So taking a step back, and this will get to that great question about the difference between instant payments and wires. And the key legal takeaway that I want to leave you with here is, one, again, as we talked about, at the end of the day, an instant payment system is just a funds transfer service. Like I mentioned, it is a real-time credit push from bank account to bank account. And it's not that different from chips or Fedwire funds from that standpoint. But what is new functionally is the speed. These instant payments are designed to support your really fast end-to-end process, all within a 20-second window. And how this is done, a key part of this is the legal framework. So I mentioned the truncation, the shortening of the payments chain for instant payments. That is a legal construct. As a lawyer at the Fed, back when I was writing the FedNow rules, so the FedNow rules, that's subpart C to Reg J, it really struck me that in building the legal framework, that was as much building a key piece of this new payment system. There's the technology and the product build. So you need the settlement engine and you need the information exchange to support that pinging back and forth that we talked about. You absolutely need that. But the reason why an instant payment system can be so fast is because of the legal terms. So I mentioned one key legal term. It's that there can only be these two banks in the funds transfer chain. That's Kermit's bank there and Fozzie's bank there. Kermit isn't allowed to say that he wants the payment to actually flow through another bank too. For example, Kermit can't say that he wants to add in an intermediary bank before he even gets to the instant payment system. So this is one key aspect of how an instant payment is different from a wire transfer. I mentioned earlier, wire transfer is an open system. That means a payment chain going from Kermit to Fozzie. That chain can wind through any number of banks to reach the recipient's bank, and that could potentially take forever. So here, by the system rules, this is the same for RTP as it is for FedNow. There can't be additional intermediary banks. It's an intentionally short payment chain. Another key legal term I mentioned is that last leg, that last link between Fozzie's bank and Fozzie, where his bank agrees that it'll make funds available to him immediately. So this requirement is built in as a service term to the legal framework that governs RTP and FedNow. There isn't a similar service term for chips or for Fedwire, for wire transfers generally. And this requirement is critical. The service term is critical for instant payments because it's not very useful if you have a super fast interbank clearing and settlement system unless the end user, Fozzie, ultimately gets access to his funds immediately. So this speed of instant payments, it can actually be a double-edged sword. So fraud and error, those can be harder to avoid with instant payments since the payments settle irrevocably without much time to catch mistakes. So instant payment systems like RTP and FedNow, you'll hear that they have fraud prevention features. But ultimately, it's the banks, not necessarily the instant payment system, that are responsible for addressing fraud and errors for their customers, which, if they are consumers, also benefit from consumer protection regulations. So for example, there's a risk of fraud where a bad actor, here, let's say you have Gonzo. Gonzo, through some tactics, he gets the payment initiated out of Kermit's bank account. Think of account takeover scams where fraudsters like Gonzo use phishing or other scams to mine for the private financial data of their victims, like Kermit. The fraudster here, Gonzo, would then use that private financial data to get control of the victim's accounts and then push the payment from the victim's account to an account controlled by the fraudster. So the money goes to Camilla under some scheme that maybe she's colluding with Gonzo on, for example. So this is one scenario where the instant payment, the speed and efficiency, it's not so useful. Because of the speed that instant payments move at, if Kermit is not actively monitoring his bank account, then he may not even know that his funds are being stolen until the funds are already gone. So there's also the risk of user error. So think, for example, where Kermit makes an alias-based payment. So he uses Fozzie's email address in lieu of Fozzie's bank account to identify Fozzie as the recipient of the payment. But say Kermit mistypes that email address and sends it to fuzzy@gmail.com. So when there's so much greater convenience on the payor side and that fast finality of payments, sometimes that speed and that ease may work against the end user. So banks that participate in instant payment systems, like other payment services, they serve as the primary line of defense in protecting their customers. The challenge, though, is that once the money is pushed to the recipient's designated bank account, there is often no way to recall the payment or get that money back given the speed of an instant payment. So this means that the mechanisms that banks traditionally have in place to identify and stop bad transactions before they occur, those mechanisms may not be so effective here. And that's why you see RTP and FedNow offering and building fraud tools that are designed to help banks recognize aberrations and flag problems in real time. And I think this was covered earlier. There's an emerging trend called authorized push payment fraud or fraudulently induced payments, also known as scams. This type of fraud also takes advantage of the irrevocability, finality of instant payments. So briefly in this scenario, fraudsters typically try to trick their victims into voluntarily sending payments from the victim's bank account to a bank account owned or controlled by the fraudster. So for example, suppose Gonzo sends an email to Kermit purporting to be Kermit's contractor for house renovations that Kermit is doing, and tells Kermit to ignore the payment instructions that Kermit actually already got from his contractor, and instead make payment to Gonzo's own bank account. And Kermit goes ahead and suppose he does exactly as Gonzo's email instructs, thinking it's actually his contractor. So this is an example of a type of scam known as business email compromise, where a criminal sends an email message that appears to come from a known source, making a legitimate request for money, seemingly, and dupes their victim into authorizing such payments. So this is different from the unauthorized payment in that here, Kermit actually does authorize the payment and instructs his bank. He was just tricked into doing so. With instant payments, because they are irrevocable and because settlement happens in real time, victims can't reverse a payment and the funds are usually gone by the time the victim discovers the scam. Now, as we walked through, there are different ways where things can go wrong. Now, in a typical unauthorized transaction, where the transaction is just plain unauthorized. So suppose Kermit is sitting in a coffee shop, gets up to order another latte, but he leaves his phone unlocked sitting on the table. Gonzo could come in, go to Kermit's payment app, and get into his bank account to send himself, Gonzo, $1,000. That's an unauthorized electronic fund transfer, clearly covered by Reg E. It's a transfer from a consumer's account, Kermit's account, initiated by a person other than the consumer, Gonzo, without actual authority to initiate that transfer, and from which the consumer, Kermit, receives no benefit. So Kermit has protections under Reg E to let his bank know what's going on. And if that's timely, Kermit benefits from Reg E's liability protections. Then there was that case of a misdirected payment that we walked through, where the transaction is absolutely authorized, but Kermit made a mistake. Maybe he wanted to pay Fuzzy at this particular email address, fuzzy@gmail.com, and he does send the payment to that email address, but he finds out later that he actually typed out the email address wrong. So that would not be considered an unauthorized transaction covered by Reg E because Kermit absolutely authorized it. And the mistake in the email address was made by Kermit, not his bank or the instant payment system. Now, you might have network rules, like for Zelle, where there are terms or an agreement for the banks to work together in good faith to get that money back for Kermit from Fuzzy the squirrel, that type of thing. But that's not the same thing as Reg E protections. Then the last one, go ahead, Ashley.
Sure. We have a couple questions in the chat. It says, if an RDFI does need to return an instant payment and the funds are still there, would it be sent back via the instant payment channel or something else?
It doesn't necessarily have to be. It's not the same as ACH, not your rules. There might be an agreement, possibly. It might be at a level above the instant payment system. It might be some other overlay to the extent that there is a requirement, to the extent that the receiver's bank has to return funds. It doesn't also have to be necessarily over the instant payment system.
You might cover this later, so if you do, you can just ask us to hold off. But Daniel's asking, what's the most common use case for instant or real-time payments?
I think a common use case right now, the challenge is that's still being built out. When you're building a new payment system, it's only as useful as the banks that are participants in it, the banks that have enabled their customers to access instant payments. I think one limiting factor has also been the dollar thresholds. I can't remember the dollar thresholds off the top of my head for FedNow and for RTP, but that's usually limited for larger dollar value transactions like house purchases, for example, where it's been increased to enable that to be able to support those kind of payments. I think another typical example, it's also small businesses. For example, they can manage their cash flows, including over the weekends during off hours. I think a thing to keep in mind too, this is a good question, is that, I might be jumping a bit ahead, but the key thing about instant payment systems today, right now, is that they're domestic only. They involve account-to-account payments for accounts that are in the United States. So a use case that is not supported, that's not planned currently, would be remittance transfers, for example, or connecting to another instant payment system abroad, as another example. For now, it's purely domestic transfers.
Thank you. And while I'm here, I'm just going to go ahead and give the code so I don't have to interrupt you again. The code for this session for CLEs is 6000, 6000. All right.
Thank you. So I think we're up to that last row there. This last one is a true scam. So like the business email compromise example, where the real fraud is around getting you to send money to a fraudster's bank account. Well, again, the consumer is authorizing the transaction, but under false pretenses, a scam. That's where a lot of the policy focus is today, because it doesn't fit Reg E's definition of unauthorized electronic fund transfer, because it actually is authorized. So instead, this is where you see banks emphasizing consumer education. You also see some staff training to help identify and avoid potential scams. You also see some banks and payment apps that put in place measures to actually slow down payments to give the consumer an opportunity to verify the legitimacy of the payment, to think a bit more about, is this a payment I want to irrevocably make? Great. So I'm going to spend a bit of time on this and then leave some time at the end for questions. One question I often hear around instant payments is how other laws come into play. So take, for example, Regulation CC, which implements the Expedited Funds Availability Act. Under Reg CC, funds received by a bank via an electronic payment, so think of Fozzie's Bank and that interbank settlement. Once Fozzie's Bank gets the funds, it shall be, under Reg CC, quote, available for withdrawal by the recipient, so Fozzie, not later than the business day after the banking day on which funds are received. So the question I often hear is, how does that apply to transfers over instant payment systems? Well, first, Reg CC's requirements are wholly independent from the legal requirement they mentioned earlier for Fozzie's Bank to make funds available to Fozzie immediately. Those are service terms of the instant payment system. So think of Reg CC's timing requirements as the outer boundary on funds availability. It has to be the same day. Service terms for an instant payment system, they can require funds to be made available on a more prompt basis. So for example, if Fozzie's Bank accepts a payment order and receives settlement over the instant payment service at 10 a.m. today, but Fozzie's Bank doesn't make those funds available to Fozzie until 5 p.m. today, then Fozzie's Bank has failed to satisfy its obligations under the service terms of the instant payment system, even if it has satisfied its obligations under Reg CC. And this distinction is important because Reg CC has civil liability provisions and comes with a private right of action. Service terms for instant payments don't have those sort of provisions. Another distinction is that Reg CC has its own definition for, quote, available for withdrawal. That is very different from the requirement to immediately make funds available under the service terms of an instant payment system. So it's worth reading Reg CC, its terms very closely. So another question I often get is how sanctions come into play. Are these instant payment service terms seriously going to require a bank to immediately post funds to an OFAC sanctioned recipient? The answer is, of course, no. I mentioned earlier when we walked through the instant payment flow that a recipient's bank can indicate that it intends to accept or reject or accept without posting, which means some of the pre-checks of that transaction are pending or delayed. It's that last option, accept without posting, that allows the bank extra time to run checks where it has reasonable cause to believe that the recipient is not entitled or permitted to receive payment. So if the bank has reasonable cause to believe that making funds available to the recipient may violate applicable US sanctions, then the bank may notify the instant payment system that it needs more time to determine whether to accept the payment order, including to investigate if the recipient is subject to applicable sanctions. In the event that the recipient's bank gives this type of notice, except without posting, the bank gets an escape hatch, and it wouldn't be deemed to have accepted the payment order, wouldn't then be required to post funds immediately to the recipient. And then finally, just briefly on bank fintech partnerships, and I want to leave time at the end for questions. The OCC has noted that faster, always-on, real-time nature of instant payments, this creates new risks and necessitates enhanced liquidity risk management, third-party risk management, and fraud and compliance risk management. So as the speed of payments accelerates, the federal banking agencies are thinking carefully about the risks and controls around it. And you can see this is evident in the request for information issued earlier this year by the federal banking agencies on, quote, bank fintech arrangements involving banking products and services distributed to consumers and businesses. So there is specific mention of payment-related bank fintech arrangements, including instant payments. So note that the service terms for RTP and FedNow, they both enable banks to rely on service providers like fintech companies to deliver instant payments. And fintechs are interested in entering into these arrangements with banks. These fintechs would be able to gain a sort of access to the instant payment system. And in exchange, these fintechs would take on responsibilities, perhaps to market, distribute, or otherwise facilitate the end user's access to instant payments. So think of that end user interface, that component of an electronic payment. So while the federal banking agencies have existing guidance relevant to bank fintech partnerships broadly, they're considering whether they need to further clarify their supervisory expectations with respect to arrangements specifically in the payment space. So this is an area that I would keep an eye on for more developments. And I wanted to leave time at the end for questions. So let me pause here if there are any other questions from the audience.
Yeah, we do have some good ones here. So JJ is asking, if an FI doesn't accept checks or deal with checks, does Reg CC still apply?
You said checks. So there is part of Reg CC that applies to checks, but it also applies to wire transfers as well. So the bank accepts, sends, offers wire transfer services, and there are provisions in Reg CC that you should pay attention to.
And then Lou has a two-part question. Are there rules or evolving terms, agreements, and standards that govern if a merchant accepts instant payments from a consumer, as with a pay-by-bank model? And then what rights does the consumer have for dispute or chargeback?
That's a great question because what's interesting is disputes, chargebacks, those are card concepts, card terms, which is usually how merchants receive payments from consumers. You can see an instant payment model where there's a QR code possibly. I think what is the challenge around fitting instant payments, a wire transfer, into the merchant customer model is that the merchant is the one that's often initiating the payment. The merchant, enters, swipes the card, takes the action. Here with instant payments, you might have the customer pull out their phone and then bring up a QR code possibly that the merchant has, and then initiate a payment from there. So the rules that apply, there could still be the usual terms are having a bank account, being able to access it to send and receive instant payments. You might also see then, again, that interface, that end user interface role. It could be a different party that offers maybe that QR code functionality. It's really that interface piece that is critical to adapting, making instant payments, which again, it's a wire transfer, it's very versatile, but it has to be usable in different contexts. So for merchant accepting payments, you might see arrangement like that, and it's possible then that there might be additional terms, additional provisions, agreements that apply to that end user interface layer.
Long one that just came in, so if I stumble over it, I apologize. Kim is asking, just to get clarification on a previous question and the answer provided, RTP can only be utilized via UX with a bank platform using a bank account where the payer would initiate the RTP through his bank rather than initiating RTP on a merchant's own payment portal. Is that correct?
So this is an interesting one because I think there are layers, like just focusing on the initiation piece. Just to send a credit push payment, it would typically be the sender, so the individual initiating the payment. However, there is functionality within instant payment systems. So this is RTP and FedNow. They both support this functionality. It's also not unique to instant payments. Wire transfers also have this called request for payment, RFP. Now that is a payment message type that the recipient of the payment, it's kind of the functional equivalent of an ACH debit. It's not actually an ACH debit itself, but it allows the receivers to, in effect, do something very similar to a pull payment. So this request for payment is a message. It's a message that the payee will send through its bank. The bank will then go through the instant payment system to reach the payor's bank, so Kermit's bank in that hypothetical, but it's just a payment message. It's just a request. Can you please initiate a payment, an instant payment to me? That Kermit Hermit's Bank, again, the payor can accept or reject, can say yes or no. If they say yes, then a payment is immediately initiated. So in that way, it could be what you've described here, where you have a utility company or bill pay company. You could use their interface, and then that starts a request for payment that the payee, the utility company, the whatever company is sending like billing would initiate itself through a request for payment.
And she added on there, where are the areas where you would see a third party payment processor fitting into this process, if at all?
I think in terms of a third-party processor, there are different roles. So let's zoom in on the bank, right? It's the bank that faces the customer and its customers, and it's the bank that also connects to the instant payment system. So for third-party processors, often banks, especially smaller banks, community banks, they rely on these processors for back office functions to be able to connect to the instant payment system. And these third-party processors, they can also offer an extra benefit where they can help route across different payment rails. You have instant payments, the processor can help connect the bank to the system, but the processor can also enable the bank to maybe coordinate or to be more of a single point, like a dashboard, to manage ACH, wires, maybe check as well, and then instant payments. And that's one role that's the main role that I see for a third-party processor. Another role, and this is not so much a processor, actually, it's really the interface role, where it's the way that the bank connects to the end user, the customer. It's possibly the interface. It could also be maybe supporting, it could be supporting fraud tools. Another level I also mentioned is alias-based payments, having a directory, but that would likely sit more at the system level, the instant payment system level. I say this to say that there's a whole ecosystem around instant payments. It's a bit different from wire transfers in that it has to be usable, has to be suitable for consumers and for small businesses. So while the back office, the typical role for third-party processors, that may not be too different from ACH wires and just add on instant payments to that. There are these other roles that are more on the customer-facing side, so not quite processors, but an important role nonetheless. That's a bit unique to instant payments.
We had Daniel ask, do FedNow and RTP work together, or are they mutually exclusive?
So that's an interesting question. This is one on interoperability, which I worked quite a bit on when I was at the Federal Reserve. So I would say there are different concepts of interoperability. There's pure interoperability, so you think of ACH systems, where you have the Fed system, and you also have the clearinghouses system. And a message sent through one can also go through the other and reach end users. That's the ultimate, to me, interoperability. It doesn't work that way for instant payments. It's not that way either for wire transfers, unless you string them together, but that's a bit that's a bit odd. I'll put it that way. So what you see instead for instant payments, you see interoperability, a type of interoperability called message interoperability. So I mentioned the clearing function earlier, the passing of information between banks. What FedNow and RTP have done is set up messaging standards that are harmonized. So from a bank standpoint, let's say it's both a participant in FedNow and RTP. It can populate, it can fill out the payment message in exactly the same way. It's agnostic between systems, and then choose to route depending on fees maybe, or possibly whichever network, whichever system can reach the recipient. So it's compatible in that sense, but it's not quite interoperable in the sense of two systems essentially being connected together, where an end user, the ultimate end user on one side can reach another end user on the other. That's the world of ACH, and that's not how instant payments would work.
We did have a question towards the beginning that got answered in the chat, but I think it'd be good to ask just for anybody who might not be following the chat. Are instant payments similar to same-day ACH in the sense that FIs are not required to originate them, but they are required to receive them?
Actually, it's the opposite. FIs don't have to use either of these services, FedNow or RTP at all. It's totally optional. And they can also choose to send only or receive only. So in that sense, there's no obligation whatsoever on banks. I think what we often see is banks willing to just receive only because that's lower risk. You're getting money to give it to someone else. On the sending side, that's where mitigating fraud or having to educate customers is really a priority because you're taking money, like it's a push payment. So you're taking money from your customer if you're on the sending side. So everything is fully optional, including whether you use the service and what role you're willing to play in the service. And we see often banks choosing to where they do sign up, where they are a participant in the instant payment system. For now, for some, they choose to, baby steps, maybe just start with receive only.
And then we just got a question in from, oh, Stephanie just wanted to clarify that FIs in the ACH network are required to receive same-day ACH payments. They can choose not to originate. Thank you, Stephanie. And then we got a question from Matt Lowe that says, from a fraud risk perspective, the balance seems for him to weigh in the favor of maybe not using either or significantly limiting use cases of instant payments. The speed and irrevocability of payments seems to make traditional fraud prevention tools and clawback a bit less effective. He's wondering if you can talk a little bit more about what fraud prevention tools or options FIs can use to limit fraud risks within the instant payments.
Yeah, absolutely. I think, the challenge is always staying one step ahead of bad actors. So for some banks, you may choose not to implement to join as a participant in instant payment system, but you're not insulated from fraud completely. The risk is still there. And I think with developments around artificial intelligence, Gen AI, which I know will be a session tomorrow, the fraudsters are also getting more sophisticated. So in this case with instant payments, one area that I would keep an eye on that would actually be very powerful and useful as a fraud mitigant would be what is going on at the system level. What are the instant payment systems providing? Because they have a very unique line of sight into patterns, right? Dynamics, activity at the system level. It's a bird's eye view of everything that's going on. And this is actually more useful to banks in more complex fraud scenarios. So I mentioned fraudulent but induced payments, scams, where from a bank standpoint, if you're the sender, it looks like your customer authorized it because your customer did. The piece of information, the data, the line of sight that would be useful to you if you're a bank in that case, where your customer is the victim, is if you could see what is going on at the recipient's bank, because the recipient is the bad actor or is the mule account that funds are going through. So what you would see at the system level could be a lot of payments from many different banks, different sender banks, being funneled into suspiciously one single account or a few accounts and a few banks. You can detect that anomaly, and if data were passed from the payment system over to the participants, and perhaps there to be analytics involved in that as well, that kind of information, that kind of data, and tools built around that would be really powerful.
Okay. I don't see any additional questions in the chat. Matt says thank you. Jess, thank you so much. This was very informative, and we really, really appreciate your time.